Greeting from Tamil Nadu Open University. I am Dr. R. Tamilmaran, Associate Professor, School of Management Studies, Tamil Nadu Open University. Dear MCOM learners, I am going to handle the session about advanced financial management, which has placed the first course of second semester. This course has 5 blocks which contains of financial management and its application. In this video, you are going to learn about first block which consists of fundamentals of financial management and others. Is one by one I am going to list you. Now you are going to learn financial management and its objectives, scope, uses and function. Then profit maximization and wealth maximization. What are the financial functions? What are the different roles of financial manager? What are the prime objectives of liquidity and profitability? How we can measure risk and return trade-off? You are going to learn the different methods and tools of financial management. The application of the time value of money, method of analysis the time value of money, discount and compounding techniques in the time management, time value of money. The last units of this block is financial information system. Initially, you have to know what is finance. Before that, if an organization it has different functional areas according to the nature of the business. The functional management is the most common type of organizational management. The organization is grouped by different areas of specialty within different functional areas. For example, finance, production, marketing, sales is one of the department, human resources. So according to the nature, the functional areas may expand. One of the prime functional area of the management is financial. In an organization, general and functional management exist in an organic unit, forming an integral management system. Finance is defined as the management of money and includes activities such as investing, borrowing, lending, budgeting, saving, and forecasting. The finance simply says is often defined management of money or funds management. The financial performance measures assess the efficiency and profitability of investment. And we have to consider to safety of the debtors claim against the company assets. And the likelihood that derivative instrument, that is various financial instrument, will protect the investors against a variety of management of risk. The role of finance in the business flow. You have seen the different classification, different process of the firm in which where the finance is played vital role. If we see this picture, it indicates labor, suppliers, investors. They are the prime stakeholders of the management. We can procure the labor from labor market. We can procure the materials from the suppliers. We can procure funds from investors. The various ways to collect the factors of productions which are essential to make any outputs. The transform inputs to outputs when a business firm is doing as a business. Thus, that business firm makes all in collects all inputs and convert into output through production area or production department. So in which we need finance to procure funds to pay the remuneration to the employees, to pay suppliers to procure materials. So after getting this output, the finished commodity will be marketed. So it has some rotations. The inputs is transformed into output. The transformation which include, we have to confirm reinvestment the firm, we have to divide dividends, provide dividends, invest in other business for expansion or enhance the business. So once if we make more revenue, it will reach to the stakeholders, especially for investors. This is a role of finance important to the business firm. The meaning of financial management, we are going to see. The financial management is one of the most important aspects in business. In order to start up or even run a successful business, you will need excellent knowledge in financial management. The financial management is entails planning for the future of a person. If it is the business, the top management will focus on to ensure a positive cash flow, including administration and maintenance of financial assets. The primary concern of financial management is the assessment rather than techniques of financial quantification. Now we are going to see the definition of financial management. The financial management is concerned with management decision that result in the acquisition and financing of long-term and short-term of firm. What is the meaning of the acquisition? Here, acquisition which includes we are seeking funds from inside and outside the organization. Whether the funds may be long term or short term. So how we are going to manage the funds, through which how we are going to utilize the funds in effective manner. That is called financial management. Here you can visually see the financial management meaning. So here the number of questions have been asked to explain about the financial management. How are we doing and is the business profitable? What we want to do in the business and how the business will make profits. Next, how much cash do we have on hand, and can we pay our bills on time, which indicates that working capital of the business. What should we spend our funds on? Operating activities or non-current activities? Where will our funds come from? From internal operations, from lenders, from shareholders? How will our investors interested be protected? How much will it cost? So many questions in it. We have to give the solution of these questions which reflect to manage the funds. That management of funds is also called the financial management. But now if we see the statement of financial position, one side is assets, another one side is investors. The investor side we can take into account, that is a procurement of funds. The company can procure funds in various ways. For example, we can raise the funds through issue of shares, issue of debentures, or issue of preferential shares, or we can get long-term loan from the any one financial institutions. The cost of finance may be around or 7%. That funds can be utilized in startup any business or expansion of business, or if you're going to start up any new ventures, start a new branches, this amount is diverted to that. So after that, how much we are going to return from this investment, that investment shall be higher than the cost of financing. Here it shows 10%. So we have already collected or acquired funds from outside at cost of 7%, by which we have invested same amount to the business in profitable manner. The company itself has earned 10%. The 3% is indicates that profitability. So how we are going to the acquired funds to manage, to enhance the profitability, it is called the financial management. Now, importance of financial management. Maintaining enough supply of funds for organization, ensuring shareholders of the organization to get good returns on their investments. Next is the optimum and efficient utilization of the funds. So depend upon the output based inputs of funds. The financial management is ascertain the financial performance of the firm. The financial management is coordinate with other functional area of an organization. It give more importance to the decision making. If you take any decision, the financial management or projected financial management will support any positive decision. The mobilize and corporate and individual savings will decide by the good financial management system. It also gives essential to help in profit planning of the organization, cost control and inventory management. Now we have listed several uses of financial management. It provides guidance in financial planning. The financial manager have to make plan. According to his plan, The financial management is give lot of guidance to derive how to utilize, how to procure the funds. It also assists in acquiring funds from different sources. I have already informed you, discussed you regarding different sources of finance. The finance management helps in investing appropriate amount of funds to other business or other projects. The good financial management system increases organizational efficiency. It is also guide to reduce delay production. It cut down financial cost or unnecessary financial cost. If you make good plan of acquiring funds by which the company can reduce cost of acquiring funds, it ensures proper use or utilize of the funds. The financial management helps the business organization to take any financial decision. The financial management proposes guideline for earning maximum profit with minimum cost. It is also assure and increase shareholders' wealth, who is the prime investors of the company. It can control the financial aspects of the business. It provides lot of information through financial reporting, which is to be submitted to the management. It makes employees aware of saving funds. The objectives of financial management. There are two major objectives. One, profit maximization. Another one, wealth maximization. The profit maximization is regarded as primary goal of every companies and one of the purpose of financial management. It is the ability of a firm or a company to earn most profit at a lower cost. According to the financial management, profit maximization is the method or procedure that raises the company's earning per share, in, in short EPS or profit. It simple means the maximization of shareholders' wealth. The profit is very essential of every business. No business can survive without profit. Profit is a measurement of efficiency. If the company is earning more profit, it indicates that company is having some sustainable growth. So the profit is related to the risk. Whenever the company is taking more risk, which will reflect in the profit. So the competitions are adverse in government policies. We have to adapt and maintain the or face the risk. According to the risk, company in several lot of profits. The wealth maximization is the appropriate objective of an enterprises. It is a combination of two words, wealth and maximization. A shareholder's wealth maximizes when the net worth of a company maximizes. To be even more meticulous, a shareholder holds a share in the company or business, and his wealth will improve if the share price in the market increases, which is the function of net worth. This is because of another name of wealth maximization is net worth maximization. When the firm maximizes the shareholders' wealth, the individual stock is wealth to maximize its individual utility. The functions of finance. The functions of finance can classified into two major categories. One, procurement of funds, another one, utilization of funds. Procurement in simply says this is a sources of funds. So as a financial manager, you have to concentrate more on procure the funds with minimize the cost. The next part is utilization of funds, that is application of funds. Once the funds is procured through several sources, how the company is going to utilize in the effective manner. The main objectives of or prime objectives of utilization of funds is to maximize the profit or maximize the return. The procurement, which can be classified into two, one long-term sources, another one short-term sources. Likewise, the utilization of funds also short-term investment and long-term investment. If we take procurement of funds, either long-term or short-term sources, again it can be classified. The long-term sources of funds can classified into two, one own funds, another one loan funds. The own funds indicates that the company can procure the funds through issue of share capital. Next one is loans capital. It simply says that is a debt. The debt capital can derive from outside in terms of issuing debentures or receiving any long-term loans from financial institution. How we are going to collect these funds in different modes like own funds or loan funds through the long-term sources, the financial techniques can adapt, such as capital structure decision and financial decision can adapt for procuring funds economically. In short-term sources, current liabilities, which include creditors, another one payables, which connects with the business, day-to-day business. If we procure any materials from the suppliers, or if related with any banks or financial institutions, we have to settle the amount in short span of time, so it may be within a year. So for which the company has adapted, the company adapts working management decision. If we come to other side, the utilization of funds, again it can classify into two, one short-term investment, another one long-term investment. The short-term investment can classify, one is a current assets, long-term investment. Under the long-term investment is a fixed assets and projects. After procure the funds, so the company will go for acquiring new business or investing in fixed assets according to the projects. After that, the company will consider the current assets, which include the stock, debtors, cash, the operating position of the companies after the making finished goods. So the goods may be maintain this inventory, or we can sell it in the customers in debit basis. We can maintain funds in the banks. So these current assets and current liabilities can easily measured through to apply the working capital management decision. The fixed asset and projects by which the company will take investment decision through the apply the concept of in capital budgeting techniques. According to the business decision, the financial management can classify into three. One, investment decision, financial decision, dividend decision. The name itself specifies that the decision related to the investment, whether it is fixed asset, working capital, investment, etc. Also, during the time of expansion of the firm, the liquid asset and the fixed asset will be considered as this investment decision. Whether we can invest it, the capital budgeting techniques and the working capital management techniques will support the effective manner of investments. The second one, financing decision. This decision related to uh, equalization of funds, utilization of those funds, forecasting the return based on the investment, which helps when you procure the funds, they will adapt a technique cost of capital. After apply the cost of capital, the company will go for capital structure decision, which help to the management to effective composition of capital. The leverage also support to take the financial decision. The dividend decision, there are the decision related to sharing activity of obtaining profit. The sharing will be done in two ways. One is profit for shareholders and other is retained profit. So the dividend decision which include the company will announce the dividend according to the dividend policy. Another one, the company will sometime will go for the retained its earning. The next one is role of financial manager. The financial activities of a firm is one of the most important and complex activities of a firm. Therefore, in order to take care of these activities, a financial manager performs all requisite financial activities. Financial activities which may which classified in two major functional areas. One primary function, another one emerging roles. In a primary function, performing financial analysis and plan. If you are a financial manager, you will analyze the financial statement by which the manager will make some plan for short and long term. Another one, investment decision, financing decision, and dividend decision. These decision we have already discussed. Then emerging role. The emerging role which include financial engineering. Here, the financial engineering is the use of mathematical techniques to solve financial problems. So the financial manager is also supposed to the foreign exchange management nowadays. His role to look at treasury operators in to give communication to the investors, the management control through the funds management, investment planning, pension fund planning, credit management, tax management, insurance risk management. So the role of financial manager has been looking at both primary and emerging roles. The liquidity and profitability, which is a main component of the business in the financial management. In a company analysis, the two major parameters for analysis are profitability and liquidity, which are the two important criteria for a company to have credit worthiness and have an increasing market capital and market share. The liquidity means that a firm has adequate cash to pay for its bill and to make a sufficient cash to make unexpected large purchase. The firm has sufficient cash to meet emergencies at all times. So the liquidity measures time and ability it takes it to convert your assets such as accounts receivables into cash to manage immediate and short-term financial obligations. If a other part is a profitability. Profitability on other hand requires that the funds of the firm are so used as to yield the highest return. The profitability refers the company improvement in margins. Margins refers to revenue cost. The more margin are increasing is a sign of good management of the company. In simply says that liquidity and profitability in nutshell, high investment in working capital and more liquid but may not be using working capital efficiency, less profitability. Is other side, low investment in working capital, less liquid but may be using working capital efficiently and more profitability. The liquidity of a firm is measured primarily by current ratio and net working capital ratio, whereas profitability is measured by return on investment and return on equity. Risk return trade-off. Risk is the chance that investment's actual outcome will differ from expected outcome, while uncertainty is lack of certainty about an event. The main differences between risk and uncertainty is that risk is measurable while uncertainty is not measurable or predictable. So the financial decisions of the firm are guided by the risk and the risk return. So the return is equal risk-free rate or risk premium. How we are going to explain risk return in investment? You have seen it. One axis is return, another one risk. How we are going to combine? When it comes to investing, risk and return come hand in hand. You cannot have one without others. As an investor, typically you need to take on more investment risk in order to realize higher investment return. While this is not always case, In general, investors should expect this relationship to hold. If an investor is unwilling to take on investment risk, they should not expect returns above the risk-free rate of return. If you see that whenever if you take the more risk, you can get more profit according to the financial decision. Next, time value of money. The time value of money refers an idea that money available at the present time is worth more than same amount in future due to its potential earning capacity is called time value of money. In short, TVM is the concept that sum of money is worth more now than the same sum will be at future date due to its earning potential in interim. The time value of money is a core principle of finance. A sum of money in the hand has greater value than same sum to be paid in future. The time value of the money is some affects how we are going to spend in the routine life, saving, borrowing, investing. The meaning and the effects, the time value of money is defined as concept which states that purchasing power of money differs with passage of time. The reason for this concept, uncertain future we can't predict. Inflation is a discounting model. Attached to the interest fact, these things will make some effect in the investment side. So the time value is very essential to the financial management, is an application to the financial management, the investment techniques. The time value of money, it gives some inputs to the learners year 1, year 2, year 3, year 4, what will be your deposits will going up according to the discount model. The special application of the time value, the future and the present value of techniques have a number of important applications in finance. We will study 4 of them in this section. Determine deposits needed accumulated a future sum. If you invest any amount in bank or financial institutions, it will accumulate it. Loan amortization, finding interest or growth rates in future, finding unknown number of periods. So this is a special application of time value. Next, we are going to see the what is the financial information system. The financial information system is a computer-based information system that gathers, stores, and analyzes the financial information, which is the further useful for decision making. Financial is also useful for the financial planning. It helps in the decision making and it is also working in conjunction with decision support system. The feature of good financial management. Keeping all payments and receivable transaction in the according to the cycle, amortizing the prepaid expenses. So keeping track of liabilities, maintaining income expenditure statements and balance sheet, keeping all records up to date, maintain complete and accurate accounts, minimizing overall paperwork. So all the financial system we can make a enterprise-wide information system or end-to-end information system so as to we can get the information in very short span of time. The financial information system is a clearly pictured here. Financial support this automation and the integration of public financial management process include budget formulation, execution, commitment control, cash and debt management, treasury operation, accounting, and reporting. The input subsystem transform the database through which we can get output subsystem. Change in role of financial management. The role of financial management is particularly in business in changing response to technological advances that have significantly reduced the amount of time it takes to produce financial report. Types of financial managers include controllers, treasurers, credit managers, cash managers, risk managers, and financial managers.